Stop what you're doing. Look at these two charts. For the last 48 hours, a silent price war has been underway, and the Western financial system is losing. Right now in Shanghai, China, physical silver is trading at an unbelievable $73, a massive, unprecedented premium over the paper price you see flashed on Wall Street screens. This isn't just a fluctuation. This is a definitive signal that the official price is a lie. For the first time, we have the evidence. The world is running out of physical silver. And if you've been waiting for confirmation that precious metals are the real hedge against what's coming, this is your moment. Because here's what nobody's telling you. Industries around the world only have a 5-week supply of silver at any given time. 5 weeks. And when that runs out, the price you're seeing in New York becomes irrelevant. The only price that matters is what you can actually buy metal for. And right now, that price is in Shanghai, and it's $73. Why this should terrify Wall Street? Let me explain what's happening in terms anyone can understand. In a normal market, global prices stay connected through arbitrage. If Shanghai trades higher, banks buy cheaper metal in the West, ship it east, sell at the higher price, and pocket the difference. That activity closes the spread. It's automatic, it's mechanical, it's how markets stay aligned. But that's not happening. The premium in Shanghai has been sitting at $4, $5, sometimes $6 over the Western paper price for days, and it's not closing. That tells you something simple and terrifying. The bridge is broken. Either the metal can't move, the metal isn't there in the size required, or delivery risk is so high that arbitrage isn't risk-free anymore. And once arbitrage breaks, the spread stops being an opportunity. It becomes a weapon. Because now Shanghai sets the real price, and the West is forced to either follow or admit they don't have the physical metal to back up their paper contracts. Why silver? Why now? Here's something most people don't know. The word for silver in French is argent, but argent also means money. Depending on the context of the sentence, you only know if someone's talking about the metal or money itself. The word stays the same. That's not a coincidence. Silver has been sound money for thousands of years. It's literally in the language. And I'm French-Canadian, so I've always had a soft spot for silver. But this isn't about sentiment. This is about supply and demand hitting a breaking point that was decades in the making. Silver has been suppressed for years. Gold too, but silver even more so. And now the cracks are showing because demand has exploded while supply remains dangerously tight. Let me give you the numbers that matter. AI infrastructure and data centers require massive amounts of silver for wiring, circuit boards, and thermal management. Electric vehicles use up to 1 kilogram of silver per car, and the world is phasing out combustion engines. Solar panels are being rolled out globally, and each one contains silver paste for conductivity. And with geopolitical tensions rising worldwide, defense manufacturing, which also relies heavily on silver, is ramping up production. But here's the kicker. You can't just mine more silver on demand. About 70% of all silver mined globally is actually a byproduct of mining other metals like copper, lead, and zinc. You can't just open a silver mine quickly. It takes 7 years on average to bring a new mine online, if you can even find a deposit worth extracting. And while demand has exploded, supply remains constrained. Industries only have 5 weeks of silver supply at any given time. Think about that. 5 weeks. If procurement stops, if deliveries delay, if one major supplier pulls back, the entire global supply chain seizes. That's why Shanghai is leading. Because the physical market, the real market, knows the inventory isn't there. And they're bidding accordingly. The bridge is broken, and it's not coming back. Here's what you need to understand about what's happening right now. The only market that consistently tells the truth in a physical shortage is the one closest to the physical flow. That's Shanghai. Not New York, not London, it's Shanghai. Western banks have been controlling silver prices for decades through paper contracts, futures, options, ETFs that claim to represent physical metal but rarely deliver actual bars. As long as everyone believed paper was equivalent to physical, the system worked. But in a shortage, paper is only powerful if people accept it as final settlement. Shanghai leading exposes the contradiction. New York prints one number, Shanghai prints another, and the market starts asking, Which one can I actually buy metal at? When that question spreads, confidence collapses. And when confidence collapses, paper markets don't adjust politely. They break. Because shorts aren't just losing money, they're losing time. A short position can survive a slow grind higher. It cannot survive a fast repricing, plus a physical premium, plus delivery stress. If Shanghai prints $73 or higher, it tells every short seller, you are short in the wrong place. And that's when they all do the same thing at once, cover. But covering is buying. Buying in a thin market is acceleration. Acceleration forces more covering. That's the spiral. The 4 triggers that could push Shanghai even higher. Let me show you the 4 specific triggers that can push Shanghai past $73 in the coming sessions. This isn't vague speculation. This is market mechanics under stress. Trigger 1. The premium doesn't close, it expands. If the West had free metal, the spread would be closed already. If the West had easy delivery, the spread would collapse under arbitrage pressure. But if the spread is still there and widening, it means something is clogged. And when the pipe is clogged, price increases. Don't bring supply, they bring fear. Fear that becomes bids. Arbitrageurs aren't stupid. They understand basic math. If there's a $4 or $5 premium in Shanghai and it persists for days, why aren't they closing it? Because they can't get the metal in the West in the size required, or they don't trust delivery, or the cost of moving it is rising. Any of those reasons means the same thing. The system is stuck. Trigger 2. Thin liquidity makes normal buying look like a spike. Shanghai doesn't need 1 million buyers to spike the price. It needs a handful of serious ones. An industrial buyer, a refiner covering, a wholesaler securing inventory. In thin liquidity, a few orders can print a new level and force everyone else to reprice. That's how you get $72, then $72.70, then $73.15 before the public even understands what happened. And once a new level is printed, it becomes psychological. Sellers freeze because they don't want to sell too low. Buyers chase because they don't want to be left behind. The premium self reinforces. Trigger 3. The West tries to manage the price and fails. If Western banks try to defend levels by selling paper into rallies, they risk triggering the exact thing they fear. A forced cascade. Because on the other side of those paper sales are buyers who don't care. And once the market senses weakness, once it senses they can't push it down anymore, bids get more aggressive. Shanghai sees that and says, fine, I'll take the lead. This is the bank's nightmare. They're used to controlling price by selling paper contracts, but when physical demand is strong enough, selling paper doesn't suppress price, it just exposes that paper is disconnected from physical. Trigger 4. Physical fear spreads faster than headlines. The mainstream always arrives late. The physical market doesn't wait for CNBC. It reacts to procurement calls, delivery times, and allocations. If even minor signs of stress appear, delays, limited quotes, elevated lease rates, tight wholesale supply, the bids get urgent. Imagine you're a procurement manager at a solar company. You need 500,000 ounces of silver for your production line next quarter. You call your supplier. They say, we can do 200,000 now, but the rest is on hold. You panic. You call another supplier. They say, call back Wednesday. You call a third. They say, we can do it, but the price is $74. You don't even argue. You buy. Why? Because your contract with the customer is worth $50 million. Losing that contract because you don't have silver costs infinitely more than paying $1 or $2 extra per ounce. That's inelastic demand. And when inelastic demand hits a thin market, price doesn't rise gradually. It jumps. Why I'm not surprised. This is finally happening. Well, I've been talking about this for a while. The price of silver has been suppressed heavily. Gold too, but silver even more so. And I've been telling people to go buy real assets like precious metals as one of the many things that will offset inflation and help them through the ultra-inflation coming in the next few years. There are credible reports that JP Morgan sold off a major 200+ million ounce paper silver short position this year and may now hold net long positions. Especially in physical silver, that's a shift away from being a dominant short seller and toward accumulating or hedging with physical metal. I think all of us are smart enough to know what that means for the short to medium term price of silver. And now it's happening. The physical market is finally asserting itself. Shanghai is leading because they're closest to the real flow of metal, and they know what Western banks are desperately trying to hide. There isn't enough physical silver to satisfy demand at these suppressed prices. This matters even more because 2027 is anticipated to be one of the hardest years economically. Hedging your future by going out and buying some physical silver now, while you still can, is one of the smartest moves you can make. Because silver will eventually explode when the world wakes up and realizes there's almost no physical silver left. What happens when Shanghai takes permanent control? Here's what the banks will do if Shanghai takes the lead. They will blame speculators. They will say the market is being manipulated. They will invoke emergency powers. They will raise margins to force liquidation. They may even pause trading, citing extreme volatility. We've seen this before. In 1980 with the Hunt brothers, in 2022 with nickel. The pattern is always the same. When shorts are trapped, they don't admit defeat. They change the rules. But here's the difference. This time, the physical market is too strong. If they close the paper market, the real trading will move to the street. It will move to Shanghai. It will move to private peer-to-peer networks. Closing the casino won't stop the game. It just proves the house is broke. And it accelerates the move away from COMEX pricing toward physical-based pricing. While intervention is a threat, it's not a solution. It's a band-aid on an arterial bleed. The fundamental problem remains. Physical demand exceeds physical supply, and no amount of rule changes can print silver bars. The bottom line is this: $73 in Shanghai isn't a fantasy. It's a logical consequence of a broken arbitrage bridge in a very fast, tightening physical market. If the premium widens even a little, if the West can't close the gap, if one serious buyer hits the tape, $73 prints, and possibly higher. And when it prints, the headline won't be, "Silver went up." The headline will be, "Shanghai is setting the real price, and the West is running out of excuses." Because once Shanghai leads, the West has two options: follow or expose that they don't have the metal. If they follow, the shorts get crushed. If they don't follow, the disconnect between paper and physical becomes undeniable. Either way, the banks lose. This isn't just another trading day. This is the line where Western control of silver pricing can break permanently. And if the West loses control of silver, confidence in COMEX pricing for all metals starts to crack. Gold follows, copper follows. And eventually, the entire dollar commodity pricing system is questioned. Silver is the smallest market. It's the most vulnerable. And that's why it's breaking first. But it's just the beginning. So here's what you need to do. Don't wait for mainstream confirmation. Don't wait for the price to hit $100 before you realize what's happening. Go get some physical silver now while you still can, from reputable dealers who actually have inventory. Because when the world wakes up and realizes there's almost no physical silver left, when industries start scrambling, when premiums explode globally, when delivery times stretch from weeks to months, it'll be too late. The price you're seeing on Wall Street screens is a lie. The real price is being set in Shanghai, and if you understand what that means, you're already ahead of 99% of people watching this crisis unfold. Subscribe, because we'll be tracking this story as it develops. The battle for control of silver is reaching its climax, and you'll want to be on the right side of history. Don't get shaken out. Don't sell. This is just the beginning.